Well, good morning and welcome to the Small Business Economic Review. We have a lot to cover today on how small businesses are faring, in addition to hearing from you in the polls and through your questions. If you would like to follow along or maybe view our slides at your own pace, we've dropped a copy of the PDF in the slide handouts area. You can also just hit that short link or scan the code with your phone. We'll also include a link to the slides in our follow-up emails. We've also placed a copy of the just released Main Street report for Q2, which contains many of the insights we'll discuss today. You can download a copy from the handouts area as well. We'll also include a link in our follow-up email. Our presenters today are Brodie Oldham and Marsha Silverman. Brodie leads a team of experts who help businesses make sense of complex data. His team analyzes market trends, builds predictive models, and creates clear data visualizations that help companies make smarter decisions. He specializes in using data to solve real-world business challenges, from understanding credit risk to spotting new market opportunities. Brodie also shares his insights as a speaker and writer, helping business leaders stay ahead of shifts in the credit market. And Marsha Silverman is a senior strategic analytic consultant with Experian since 2013. Marsha supports the Commercial Data Science Group and advises on commercial strategies, prospecting, acquisition, account management, and collections. In addition to over 25 years in financial services, she leads publication of Experian's Commercial Pulse Report. She also holds a bachelor's in economics from Haverford College and an MBA in finance from NYU. While we're presenting, we would love to receive your questions. Just hit the Q&A applet in the tool panel. We'll answer those at the end if time permits. If not, we will certainly reach out and be in touch directly with responses. And now I'd like to turn things over to Brodie for today's review with Marsha.
All right. Thank you, Gary. You know, it's a wonderful time to be together. We're at the end of our summer. Kids are getting ready to go back to school, and I have a couple that are headed back. And so my life is, getting a little bit easier this week. And so it's nice and sad all at the same time. You miss your kids when they're away, and you're always glad to have them home. And this is one of those times where I get to send them off into the world, and a world that feels a little different than it did a year ago or 2 years ago. And we're going to talk about this world today. We're going to talk about how it's going to impact our generations as they come forward into the job market and what we're already seeing there. We're going to look at how the economy is rolling, and from a consumer perspective, how easy it is to access credit, and how folks are managing their credit, which is really interesting because we're doing a pretty good job. I would say from a small business perspective, and that will be the second half. Marsha is going to walk us through some small business credit. It really will be how small businesses are starting, and are we seeing the same velocity that we've seen over the past couple years, which has been pretty tremendous, as well as look at the performance of our lenders and how they're able to lend into small businesses as they continue really a high rate of opening in the U.S. And again, I look at my kids and I say, all right, guys, one of the ways to be very successful, especially in the U.S., is to have a small business and lean into that and use it, and use your entrepreneurial spark to really set something up that's going to put you in a good position as you go forward to be self-sufficient. And of course, when you have college kids, that's what you lean into. So we're going to talk about a few of those things today. We're going to start with the general state of the U.S. And we're going to talk about some of the things that we're seeing from a GDP perspective. So when you think about it right now, and Gary, as we go to the next one, we're going to look at where we're sitting. So as we looked across the past couple months, we've been a little bit up and a little bit down, but positive over the last year, which has been really good. The estimates from the Fed were around 1.5%. We're at 1.6. Again, when we look out from the perspective of how well and how easy it is to predict growth within the U.S., we were pretty close on prediction. You can see here around 1.5% growth in the second quarter. So moving along pretty good. I think the estimates are pretty close. We have a couple more of those where we may see a revision or two coming. in the next month or so. But again, as we go forward, pretty good estimates and pretty stable in the way that we're evaluating growth within the U.S. So we know what's happening, and I think that's been really key as we go forward for investors to have some type of stability and understanding of what's happening within the market. Now, there's still some volatile points. There's still some calls from Air Force One that move markets, especially from an oil price perspective. But in general, the markets have been trending in the way that we expect, and you have the big Mag 7 again as you look across those being pretty steady on growth, and even with extraordinary growth that we see within the U.S., investors are tempering a little bit on how much they really lean into some of those big offerings. So we're going to continue to watch that as we get into next year, because those are big employers within the U.S. All right. So as we go forward, I think I want to touch on some of the big stories that we're seeing from a U.S. growth perspective, and then, of course, what we're seeing across the world. So, Gary, if we go to the next slide, what you're going to see, where we're going to start, is looking at what are some of the big things that are happening across the globe. And if you're watching TV, listening to the radio, reading your newspaper, I love a good paper newspaper, just because you have it in your hands, and I like it to be not as curated as it could be. It's, again, any form of media is curated a bit for you, but you feel like you get a little bit more span of what stories are being brought up, and my algorithm isn't getting in the way. But it's good to see what type of stories are really hitting across and impacting the U.S. And what we see here is tariffs is a big one across kind of the spectrum. We look at small business impact, we look at consumer impact and how expensive things are to buy right now. You know, we've had some tariff shifts over the past 2 years. The latest one came at the end of July, on July 24th. We had 301 tariffs that came into effect on the 24th. Again, these tariffs are ones that are covering those that were called back. And the 301 tariffs cover a little more than 99% of all goods that are coming into the U.S. So it's a good broad coverage between 10 and 12% tariff rate just across the board. That means good, bad, or ugly level across all players, all importers that are here in the U.S. You're going to pay about the same across all those. So pretty standard push. Now, of course, in the last few days, there's been pushback already against these tariffs that have been put in place. So again, we'll see some legal action that's going back and forth and challenging the law and the push to have these put just out, and what the situation is outside the U.S. and why these can be enacted. So like anything, we'll have some challenges to go to these tariffs, but right now they are in effect. We do see, when we look across, I mean, that from a business perspective and certainly from a trade and tariff group perspective, we see that it's even from over the past year, we're up about 41% as far as the impact that we see from a supply chain perspective. So that really is something that is, the feeling around tariffs is a little more heightened than it was even last year. So when we go down to consumer health, and consumers are important to small businesses. Why? Well, you know, if you remember, every time you meet with me, I'm a little closer to opening my own small business. My little pie shop is getting closer and closer. And so I'm always excited to see, you know, as a part of our small business bureau here at Experian, I am eating my own food, I guess you could say, and creating a small business myself. And in doing that, I'm certainly looking out to see how I feel about what rates are available to me. Am I able to get access to credit? How do I feel from a consumer perspective as I'm engaging in this small business market? And what's my health? Are there going to be consumers coming through the door to buy my pies and cakes? Or are they going to be really tightening up over the next couple months? So if you look at the sentiment numbers, and again, this is how consumers and small businesses are feeling, that consumer number is down. And it's been down for a little while. And you really see it not really picking up so much as we would hope. Now, does that mean that consumers are all in dire straits? No. It means that there are still some challenges about how we feel about how expensive things are and how our wallets feel. And we're going to talk about wages and growth and how that could be impacting sentiment. Now, as long as that consumer spending, commercial sentiment, so you'll see that on the top by the NFIB, that number is still cruising along pretty level and even a little bit higher than it was in prior months. So from a small business perspective, still pretty good on cash flow. Consumers are still spending. Now let's look at these wages over to the right. Now, one of the things that you're going to notice on wages is that real disposable income growth is really flat. And you're going to see that. It's been pretty flat. I think one of the challenges that we see here is that even though it's flat, you're going to see spending continue to increase. One of our things that you'll notice is that that CPI number is crossing over where wages are. That means the growth is stronger from an inflation perspective than a wage growth perspective. And that really means that, as far as consumers, they're spending, their paychecks, they're just not getting as much as we go forward. So what they're gaining in wages is kind of getting eaten up by inflation as we go forward. So Gary, why don't we open up our first poll here? And what I want you guys to do is keep your fingers on the buttons. We're going to ask you a few questions throughout our time together. And we want you to see what is happening from some of your colleagues, how they're feeling about the market. Here's our first question. Which risk are you watching most closely as a threat to your borrowers this quarter? Is it tariffs? So some companies, you have a lot of trade credit that's out there. Is it political and energy? So is it when we're thinking about some of the supply chains, or do you have a lot of trucks that are moving, and is that energy cost really weighing on you? Or is it regulatory change? And a lot of our businesses that we see now are AI startups, online retailers, regulatory and privacy changes across Colorado, Georgia, California, some of the New England states, again, are putting out some new AI policy for review by companies that are starting in their states and then being even broader to customers that they're serving across the greater United States. Well, let's take a look at how close are we, Gary? Got a pretty good number here.
Yeah, we had about 50% participation, and a clear lead is concern around pullback on consumer spending. 42% of people who participated in this one.
There you go. Certainly, consumer spending is important, and we're gonna dig into that a little bit deeper, and we're gonna get a few more of you to vote this next time. So keep your fingers ready. We're gonna have another one coming up, and we really want to get you involved in what we're doing. All right, let's transition to the next one, because we're going to start talking about some of those challenges that you are going to see across when we look at delinquencies that are happening within the market. I think you want to know, when you think about consumers, are they spending? Yes. Are their wages keeping up with inflation? It's tighter. So what does that mean from a delinquency perspective? Well, what you can see is mortgages that are 90 plus have really jumped about 55%. And that's really the clear standout that you'll see on these charts, and that's in the bottom left. When you think about it, we've had higher rates for longer. Houses are expensive, and as incomes start to not keep up as much with inflation, those windows, that ability to repay, gets smaller and smaller. And we are seeing some slowdown again in employment in the U.S., and we'll talk to some of that, but that could be impacting some of the delinquency rates here. Now, these are 90 plus for mortgage. Those are the ones that we're really watching. When you look at unsecured cards, again, you're doing pretty well. So a lot of you may be doing card products or lending products that are unsecured, still performing pretty well, and our HELOCs performing even better. And again, HELOCs are for more prime customers that have equity already available in their homes. the criteria for HELOCs have tightened up over the past 12 months. And really where the challenge is in the first mortgage side, not in the HELOC as far as delinquency levels. But again, we're going to watch this. As you're using up the credit, we still have high cost, high property value as we look across the U.S. So that equity remains there, and that keeps HELOCs in the positive, and even HE loans in the positive side. And so that keeps people liquid as far as what they're able to buy and a little more gap to spend. So that's good to monitor. But in general, consumers are handling their credit pretty well and repaying their debt at a good clip. So even though we're seeing a bump here in delinquency, it's not one that's throwing up any red flags at this point. It's just a little more elevated than we're used to seeing from a mortgage perspective, but again, not a red flag. So let's look, we're going to look a little bit more at wage growth and where that's coming from, because you want to know who's spending and who's challenged. Again, we see that our real disposable income is flat. You can see that blue line on the right-hand side. You're going to see that your spend has dropped off a little bit faster, but we're watching this again to see how lean it will get. As we're monitoring. This is always one of my favorite charts to watch because it really tells us if we can get back above those 2019 numbers, we'll be in really good shape. You can see on the left-hand side that really the expansion of wealth is hitting in the upper income segments. That growth has been significantly more for the top earners. See about 36%. Of incomes are up for those top earners, and only about 18% for the lower income sets. But when you think about who's really spending in the market, it's our top earning segments that are really spending and driving spend in the U.S. So a significant portion of what's being spent. Of course, that's opening a small business. In my case, that's where I'm spending my money, and that's to drive employment to and expand. So not all of it is just in personal consumption of what I'm spending for myself, but also what I'm spending to drive growth in the market as well. So we'll see some of that across those top earners. All right, let's look at hiring. Since I mentioned that, we're going to look at the hiring market, and I would say we were down in June at about 57,000 jobs. It's the weakest that we've seen in about 4 months. Of course, you're seeing some of those kind of come
Brodie.
down. Yes.
Sorry to interrupt. I think we have a poll. We've got a second.
Oh, we do.
Yeah. Let me just launch that. We'll get that.
Thanks, Gary. Yeah, let's pull that up. I hope everybody's ready. Finger on the clicker. So when we think about household budgets, we talked about those higher income levels doing all the spend. When you think about your portfolios, and you think about the household budgets that you're counting on for your business, are you concerned that the borrowers and those that are your customers coming through the door from a cash flow perspective are going to be squeezed a little bit in the next quarter? How concerned are you? A little bit? Very concerned? How do you feel like the market is treating consumers at this point? Again, a little bit of a challenge there on the front end, but you still see growth happening across incomes. Very concerned. Oh, that seems to be their end somewhat. All right, great. I'm glad we got up above 50% this time, Gary. Really moving. All right, let's close this one out and keep us going. Fantastic. Well, thank you for participating. I think that really helps. That tells us that a lot of you are a little concerned about what's coming in the future. We're going to see gas prices go up a little bit more. Certainly following the elections, there'll be a little bit more volatility that we'll see. Right now, the focus from a pre-election type of a market is that you'll see some calming, some volatility come down, affordability addressed in some cases. Post-election, we may see a little bit more volatility that comes, and that could drive up oil prices and create some other volatility points that you're probably already preparing for the end of the year. But in general, consumers are in good shape and are spending through that. But let's look from an employment perspective, what we're seeing within the market. So again, 57,000, you can see that in that blue, pink, and purple bar on the far right. Down a little bit more than we'd like to see it, but still positive. It's the lowest that we've seen in about 4 months. We have had some resets. I think we were hoping to keep it a little bit higher than this and stay over 100,000. But this around 74,000 seems to be about our norm in the new year per month as we go forward. Again, we've held at about 4.2% from an unemployment rate. We've had a decline in those participating, about a 61% decline since about 2021 in the participation rate. And so that's something that we're watching that slope down a little bit more. That's keeping that. As we rose above 4% into the 4.2, we're seeing some flattening in the unemployment rate. Some of that is driven because participants are pulling out of the market, so it's keeping that number right around 4%. The expectation is that that will stay for a while, that it's going to stay around 4% even into next year, even if we have a few more AI reductions that we see across the market, if we see some layoff cycles that come. The expectation is that there's still a need for employees even to build the new AI systems. We've heard that from Moynihan and Jamie Dimon over the last 30 days. They're pushed to continue to hire, to continue to build and prepare for the future. And in doing that, that's keeping this number still down around 3.5% to 4.5%, so in a percent range. So I think that's still very positive as we move forward. Still in good shape, but a little lower than we would like to see. All right, Gary, let's head to the next one. So when we look across how consumers are feeling, and you're worried that they're going to be in a little bit weaker position, let's look at inflation. So we have a new Fed chair. Our new Fed chair is very quiet. You hear from him when he wants to tell you something, and he stays quiet. What we're going to hear from a lot more are some of the committee leaders, some of the different Fed chairs. As we look across, you'll see some leads that are going to come out and be a little bit more vocal. Right now, core our CPI is around 3.5%, core around 2.6%. It's still above the Fed's 2% target. For some of us, we think the target should be around 2.5 to 3, but we're at 2% still holding as we go forward. That means that with this elevated inflation that we continue to see that's a little sticky, that means a hike is on the table. If you remember the last time we met, that hike was a very small percentage of the group that we expected it to happen. And even when we did a poll amongst all of you, it was very low, those that expected to have a hike by the time we got to the end of the year. Everybody expected 2 or 3 cuts. And especially with the new Fed chair that the administration really pushed for, hoping that they would be a little more dovish. And what we found is that the data just isn't allowing that dovishness to come out, and we still have an independent Fed. So as we push forward again, we see that the Fed held in the last meeting on the 29th, still around 3.5 to 3.75%. But you have, how many do we have? We had a couple hawkish officials that pushed back. I think it was about 3 officials that pushed back and did a split. And I think that's really the change that we're going to see on the horizon as we get into the next 2 quarters. We're going to see that hawkish side kind of step up. That means that we're likely to see, from the dot plot, we're even seeing it right now, that there will likely be some hikes and not a cut toward the end of the year. And we're looking at September when that will probably hit. Now, when the Fed usually raises rates, they don't do it once. They usually do it a couple times. Same thing when we cut rates, usually do it a couple times. And when we look back historically, every time we look at historical rates and raising those rates, you're kicking them in, you're waiting a little bit, but generally to slow the swing of the pendulum from one way to the other, it takes a couple times, and a couple rate hikes are what we expect to see over the next couple months. All right, so let's move to the next one here, Gary. So let's talk about what we're seeing from a retail sales perspective. So again, some of your customers are going to be coming in to shop, looking for a little bit of credit to pick up parts or to pick up tools or to look for opportunities to buy the products that you have. what we're seeing is that online spending is really where we're seeing a lot of the growth. I think you'll hear a little bit of that from Marsha. That's a lot of where we see the growth across small businesses are these online, and you can see they're really leaning in here. We've had a growth rate about 6.7% year to date, year over year, and that's double where we were last year. So this is really seeing some of that growth hit from a retail spending perspective, and online is really leading it. So watch for the growth. Again, we're looking for opportunity here. You can see it in services, you can see it in product as we go forward, and that retail sales number has really been elevated. So again, even though savings are down, even though we're seeing wages outpaced by inflation, we're still seeing consumers use a lot of the wealth that they're either gathering. Remember, it's a lot of those top segment consumers are using the wealth that they're gaining either from the equity that they have in their home or assets, their businesses that they're opening. They're also drawing again from the credit that's available. Credit markets are still open and available to both small businesses and consumers, and we continue to see that move forward. Demand is a little weaker, as we saw from the latest SLOOS report, but again, you see that it's open and available to consumers. Our delinquencies are down from a consumer perspective. That means that there's still that wealth effect there. Certainly from their equities being a little bit higher, it's keeping their pockets a little bit more flush, and so they're able to spend a little bit more than you would expect them to and be resilient. Even if we hit some shocks toward the end of this year, our consumers should still be in a position to continue to spend through the end of 2026. So some pretty positive perspective on consumer spending as we go forward, and those are your customers. So I'm going to take this time to invite Marsha to join me here, and we're going to look a little bit more at our commercial credit. Marsha?
Thanks, Brodie. Gareth, should we go to the next slide? With the backdrop of the economy that Brodie just shared with us, what we like to look at, and I'm sure most of you have seen this slide from us before, is how many new businesses are opening. And the pace of new businesses opening just keeps going up. And this is amazing because I keep looking at this every month, every quarter. We've shared it with you. And I keep thinking it's got to come back down, and it just keeps going up. So pre-pandemic, we were averaging close to 300,000 new businesses per month. You can see that all the way on the left-hand side. Since the middle of 2020, we have over 450,000 new businesses open each month. And over the last 6 months, we are averaging over 500,000 new businesses opening. Most of those new businesses opening are individuals, sole proprietors. They don't have intention at the time they open. They don't have intention of hiring employees. Now, maybe down the road, once they grow, they will. But at the opening, on the onset, they are just individuals opening their business, whether it's on the side, like Brodie opening his pie shop, or if they're starting a brand new venture outside of another job. And what that does for the credit space is that all these new businesses seem to be seeking credit. And on the commercial credit side, the mix of new credit being issued is getting more and more towards younger businesses and less towards the issued for more established businesses. So we see that shift in commercial credit. And if we go on to the next slide, it's really not just commercial credit, because entrepreneurs say that they are using personal finances to fund their business. On the left-hand side, this survey shows that over 80% of responders use some form of their own personal credit, whether it's their savings, loans from family and friends, their own financing for HELOC, credit cards. They are using their personal finances to start their business or expand their business. And here at Experian, we did a study in the credit card space looking at consumer cards and saying, when we look at the individual owners of those cards, borrowers, do they have a business open, a small business open? And what we found were a lot of interesting pieces to this, of those who do not have a business and have credit cards versus those who have consumer cards and commercial cards, is that middle 248 billion, where they have consumer and commercial cards. And then there's this portion of the population on the right-hand side that makes up $195 billion on our consumer file that have a business but only have consumer credit cards, meaning they're using their personal finances to fund that business that they're opening. Why does this matter? Is that those people that are using their own personal card, they are behaving more like a business. So if you look at the bottom right here, it's a little bit small, but the blue bars on either end have the outstanding average balances between $5,000 and $6,000. That's on consumer cards used for personal use. The middle bars, the pink is commercial cards that are averaging almost $10,000 on average per balance. And the purple bar, that's the second from the left, the second from the right in towards the left, the purple bar, those are the personal consumer credit cards where that individual has a business, and you see those balances are much, much closer to commercial card balances. So they are behaving like businesses. We see that they're behaving more like businesses, but they're in consumer files. Now, some may say, oh, that may not matter that much. They are getting the funding. They'll be responsible for paying it back. But lenders out there may be very concerned about this. You may want to know how your customers are using the card. You may treat them differently. Very often commercial cards have higher interchange rates. You may be leaving revenue on the table if they are in your consumer portfolio. In addition, you may grant different lines, different payment structures, different terms, different reward structures on cards for businesses versus individual consumers. And all of that, you may grant different lines, credit lines. All of that, you may be missing out on opportunities if you have these individuals that are really acting like businesses, but in your consumer file. So something to keep an eye on for you out there. We did this study. We have a lot more of that in one of our recent commercial pulse reports. So if you haven't seen that, try to go on our, follow our links and look up that report. You can dig more into it. But we thought this was a very interesting study that we did in the last couple months. So if we go to the next slide, we just talked a little bit about cards specifically, and that got us interested in how are businesses using commercial credit overall. And so we looked at the 4 key products that we break out: are cards, term loans, lines of credit, and commercial leases. And you see the pink portion in the middle of all these bars is the credit cards. So businesses predominantly rely on credit cards. That's by volume, that's the most predominant product, not necessarily by balances, but that's the most predominant product used by businesses out there. But what you can see here is when we look at it by the age of business and the size of business, both by revenue and employees, is that the older the businesses and the larger the business, they rely more on other products. So as these businesses get more established, they're branching out maybe to term loans, to leases, they're growing, and they're using other products besides or in addition to the cards. So interesting dynamic there, considering how you do your underwriting of, you may be looking at some of these firmographics to determine what product is may be right for your customers. If we go on to the next slide, it's summertime, and a lot of us are going on vacations. I haven't had one yet this summer, but trying to plan one for the fall. But we did a little bit of a deep dive into the travel sector. And what we've seen is that while there is high costs, travel demand has been very high. And you see on the bottom left-hand graph that the TSA passengers, so people going through the screening at airports, is really the highest it's been in the last several years. But the costs based on airline costs in that middle graph, the black line at the top towards the left for the first half of the year, a lot driven by fuel costs for airlines. Those prices, the airfare prices, those are higher than they've ever been for this time of year, for the first half of the year. And so even though those costs are high, people are finding a way to travel. And Experian did a summer travel survey and found that 2/3 of the respondents said they are willing to go into debt to fund a vacation, to fund travel. And you see on the right-hand graph that a good bulk of people say how they are funding their summer travel is by using some sort of credit, whether it's buy now, pay later, or credit cards. While some have intentions of using savings, maybe they save, but they still put it on that card, and sometimes they go over the amount that they've saved. So again, more than 2/3 said they're willing to go into debt for their vacation. And so if we go on to the next slide, we see how this is impacting our travel sector. And we know that leisure and hospitality, including travel, was one of the most impacted sectors during the pandemic. When things were shut down and you couldn't go out of your house, much less get on a plane, get on trains, buses, go out to restaurants. They took the biggest hit, really, almost of any sector out there. And what we've seen over the last couple of years is a massive recovery, where we're at basically a steady state now, that these industries have really come back. And so you can see on the left-hand side here, with this recovery, they are out there in the credit market looking for new commercial funds to maybe expand, to provide their services. They are looking for more credit. They are using more credit, and their delinquencies on the right-hand side, you can see that they're a little bumpy up and down. It's an unusual sector, can be hit by natural disasters or the economy, but for the most part, they have been the whole sector has been performing well, pretty much in line. You average out some of that bumpiness, really in line with all other industries. And right now, for the last 6 to 12 months, the delinquencies in the travel sector have actually been lower than other industries. So this is something interesting, and it really ties into what Brodie was talking about earlier, that despite inflation, and even despite inflation over the last couple months crossing over and rising at a higher rate than wage growth, people are still spending. And so they have that discretionary spend to spend in sectors like travel, hospitality, and leisure. And so these, as I said, these sectors are rebounding, and we see a positive future, at least in the near term, that they will continue to do well. So if we go into the next one, another sector that we did a small deep dive in is construction. Again, somewhat impacted during COVID, and understanding how that rebounded was another interesting topic for us. And just last month in July, our federal government passed a major legislation related to stimulating residential construction. So the affordability of housing, everybody hears about this, younger people might not be able to enter housing market. It's hard to age in place when you're on a fixed income. When housing costs have grown and really accelerated over the last several years, and we see that there's record high median home prices, the left-hand chart, where we are averaging, approaching $440,000 across the country for a house, the median price, and that is a record high. And so again, with that, this federal legislation saying housing is getting inaccessible to many average Americans, that this legislation is the objective is to stimulate new building, and we said that should be down the road stimulating our construction sector. And what we've seen is that in the last few years, while spending in the construction sector by construction businesses, construction spend has grown, but not on residential. So the middle graph, the blue line is overall construction, and the pink line is on residential. So residential has been really stagnant, and that businesses have not been spending money to build there, and that the spending is stagnant even with inflation. So if you have the same amount of spending and prices have gone up, then the actual number of houses being built is really down, and that's part of this supply demand balance or lack of balance here, where people want houses, they're not being built. What we see is on the right hand side to date that credit active businesses in the residential construction sector are lagging. So we are seeing in our commercial data that those businesses, aren't growing, are not, to date, are not investing. And so what we expect with this legislation is that sector will get a bump, and we're going to keep an eye on this for you in the future to see, how well this new legislation does impact the residential construction sector. So interesting information here as we keep an eye on the legislation and this sector. Gary, if we go on to the next slide, we shift from some industry deep dives just to the commercial credit trends overall. And what we're seeing here is that, we see that there are higher rates out there. Brodie mentioned the Federal Reserve. They've held interest rates flat for so far in 2026. They might even go higher later in the year, but they're relatively high over compared to a couple years ago. And banks have been tightening their standards, their lending standards. Lenders in general, not just banks, but lenders in general have been tightening their commercial credit standards. And so what we see is that originations, especially on the card side, which is the upper left, the volume of originations has been trending downwards. We see that on most of these products, other than the term loans, which has been trending up to steady. But where we see the interesting piece is that lines have not been contracting. And so businesses out there that are getting the credit, they are getting the dollars amounts about the same or even higher on the credit cards. You can see that's gone up. So when there's tightening criteria, when those most qualified applicants are getting through that criteria, they're getting the money, they're getting the dollar amounts to be able to fund their businesses at a higher level. So interesting dynamic here. And with that, Gary, I think we have a poll question for our audience. And I'm hoping to beat Brodie out here and get more than 60% of you. So get your fingers on your clicker. And we are wondering, where will you focus investment over the next quarter? Thinking about lending, are you worried on going to invest more in risk and fraud analytics, which is impacting all of us more and more every day? You automating your underwriting? Are you thinking about managing your portfolio? Once you have somebody in the door, we know that acquisition costs are much higher than managing your portfolio. Is that where you're going to invest? Are you thinking about collections? Or are you growing marketing and adding new customers, trying to seek people, new customers out there? So we're getting on the verge over 50%, but I want a few more of you to participate out there. And we are getting close to 60% of you voted. And so far, I see kind of an even split with a lot of these. And so hopefully a few more can vote so we can get a clear winner here. And Gary, it looks like,
yep,
surprising to me,
people are in growth mode, it looks like. Yeah.
The highest vote getter is, you're looking at growth and marketing. And so, looks like a lot of you pretty evenly are looking at risk and fraud, underwriting, and portfolio monitoring. So it looks like you really, it's across the board with 7% in collection. So really interesting survey here. And we'll keep that in mind for products and services that we deliver to all of you out there so that we can make sure we get you what you need. So Gary, if we go on to the next slide, is looking at delinquencies by a number of different cuts on the commercial side. And, Brodie showed you on the consumer side, some increases, especially on mortgages. On the commercial side, businesses seem to be performing well. Delinquencies are pretty much steady, stable results here. What we see is what kind of the trends that we normally see is that younger and smaller businesses tend to have higher delinquency rates. And I know a lot of you out there have those conditions in some of your underwriting policies. And we continue to see that. You can see that especially on the bottom right, where we have the largest businesses by annual sales really has quite a bit lower delinquency rates. But you see that really in all the graphs, the smaller, younger businesses tend to be a little bit riskier. But again, commercial delinquencies across the board, pretty stable, which is good news considering all those external pressures that Brodie mentioned up front, from geopolitical and rising inflation, all that stuff. Businesses are kind of humming along, and we are really grateful that that the businesses are doing well. And with that, we'll go to our next slide, which is our last slide, and it's really kind of rounding out how we see small businesses performing. And this is our Experian small business, and it incorporates kind of everything we've discussed to this point. Not maybe not everything, but a lot of those factors where we are looking at not just the commercial side of lending and borrowing, but bring in the business owners and some of the environmental impacts. And this metric, if you haven't seen it before from us, it goes from 1 to 100, where between 40 and 60 is the normal, stable environment, where over 60 is a more favorable environment for small businesses, and under 40 is less favorable. What we've seen for about the last year is in the stable range. We had some volatility last year, the tariffs and government shutdowns last year. A lot of that played into the factors that we saw some unfavorable territory for a couple of months back in 2025. But really, for the entire year so far in 2026, we see good, solid standard conditions normal conditions. And so we expect that businesses should continue, as you saw in the last couple of pages, stable delinquencies, stable balances, stable performance overall. And we are looking forward to this environment continuing, say, for the next at least several months, hopefully longer. So with that, Gary, I think we're going to open it to questions, Q&A from the audience, if we have any. Not sure if anybody has. If you haven't yet and you have one, please type it in.
I think they are being shy. They're being shy with us today. There was one question about the construction, the point about construction, and whether Experian has construction-specific scores. And I believe, Brodie, keep me honest here, I believe we do have something.
Oh, we absolutely do. So we do have a construction score, and we've developed this score to help our construction lenders and those that have different parts of the construction process that they're evaluating. It helps even in portfolios to understand, these service providers are a little different than the rest, and they make up a big portion of our credit portfolio. There's just a lot of companies out there. So this construction score leans in a little bit deeper into those construction service providers, materials, other parts of the construction process, and really helps us to segment out risk really across the range. So it's really been a very positive product for not only our lenders, but our insurers as well, our carriers. So
very good.
A big boost.
Yeah.
Joshua had questions about.
One thing to add to that is some people out there may wonder why construction was one of our first industry-specific scores. And what we've seen is that businesses in the construction sector use commercial credit very differently than businesses in other sectors. So while we know that many businesses, and you saw some of the charts, rely predominantly on credit cards, what we see is that construction businesses actually have a much higher percent of their lending products are in term loans, leases, and lines of credit, and that's the nature of their cash flow and what they need is very different than other sectors. So that's why we, as you know, Brodie, that's partly why we decided on a specific score for construction, and these industry-specific scores can really hone in on risk in that space. So very, very helpful.
Yeah. Joshua had a question about that drop in delinquency from April 2024 to May 2024. I'm not sure we can address that on the fly, but we could certainly get an answer back to you, Joshua, on that one. I'm looking through here at some other questions. Maribel asks, is there any information about how this has impacted the utility sector? I believe we do have insights on utilities, right?
Marsha, you want to take that one?
Yeah.
From a utility perspective?
Sure. So when we did the study on product usage by different industries, utilities kind of fit into more the standard, which is interesting, but they did fit kind of the average product usage. But what we are seeing is that utilities are investing so much now in big data center because of data centers that there's a high demand for investment in them, and that it's a little bit of a wait and see where it's going to go, but there's high demand of growth in the utility sector.
Yeah, we definitely see that from a regulated and non-regulated perspective when we look across the U.S. I mean, regions are all different from a utilities. I'd say we have some insights that Marsha put together over the last couple months. We're going to be at the TRMA coming up in another month, talking to a lot of the utility and mobile customers that are out there. So if you're going to that, we look forward to seeing you. it is an opportunity for us to talk about what we're seeing from an engagement perspective within market, as well as what we see from a collection and tooling perspective on the back end. A lot of our utilities are focused on identity and fraud products, and so a lot of the new things that we have coming out from a fraud perspective and what we see across the market, some fun stories of how utilities are being engaged and swaps and identity and synthetics are really impacting how utilities are managing new customers on book, and then how they look at some of those people that have been on book for a long time and haven't been paying their bills. They've been caught after moratoriums and just said that it's too much debt, they can't repay it, and so they're riding the cycle. So there are some strategies that can be done by utilities to dig into some of those portfolios, and some of those in arrears are quite big. Some strategies to do that we've seen our other customers use to dig into a little bit more and identify those that are collectible, those that need to be pushed off to the side and written off, and then those that can manage through the process. So look forward to, if you're there, we look forward to seeing you. Otherwise, reach out and we can certainly give you more information.
Very good. Sienna had asked, what is the trend for small business bankruptcies? And I know that we had seen some things recently, mostly driven by the different chapters making it easier to file for bankruptcies. Any comment on that, Marsha or Brodie?
Yeah, sure. The business bankruptcies last quarter were the highest in decades. So they are going up. A lot of that is driven by Subchapter V of Chapter 11, which was a new legislation just in 2019 that enabled small businesses an avenue to declare bankruptcies with less hurdles, lower fees, less red tape, shall we say. And so in my mind, I'm not that sure that more businesses are going out of business, other than maybe now that they have this vehicle to declare bankruptcy, more businesses are actually taking that path, where in the past they might just shuttered their doors and said, I can't go forward, but I'm not going to pay thousands of dollars and create a board to restructure. They weren't going to go through that that exercise of declaring bankruptcy, and now there's a vehicle for them to do it. So, it'll be interesting. I think there's always, or often there are unintended consequences of new legislation, and maybe making it easier to declare bankruptcy in certain cases might not have been the best way to go. So, it's an interesting dynamic there.
Okay.
Gary, in the last minute, do you want me to go back to that first question on delinquency rates going down over the last 2 years, or that they dropped down over the last 2 years?
Yeah, if you have comment on that, we'd appreciate it. Yes.
So what we see is they've really kind of gone back down, where coming out of COVID, delinquencies increased. And there was a lot of different dynamics going on there, where businesses had access to PPP loans or EIDL loans, and they had cash flow that might not have been business cash flow. So they had money on hand to pay their bills, and they had these subsidies that could keep their doors open. And so delinquencies were actually a bit lower before 2024. And when a lot of that cash on hand ran out, we saw delinquencies rise. And now they're just kind of coming back to more of a steady state. So I would say that the 2024 elevated level was more of the anomaly, than now the lower level is more of the steady state. Brodie, do you have anything to add to that?
No, I think that was well said.
Excellent, excellent. Well, I think we'll leave it there. I would like to thank everyone for attending today's review. If you'd like to dive deeper, check out the Commercial Insights Hub for more timely insights on small business credit performance. We'd like to, if you'd like to explore our commercial solutions, you can find us at Experian.com/commercial. Our next small business economic review will take place on Tuesday, December the 8th. It seems so far away, doesn't it? But mark your calendars. We'll be reaching out about that one. Thank you, everyone. And remember to keep informed, to stay ahead. And we'll catch you on the next one.
All right. Thank you.
Thank you.